Welcome to Talk ETFs, ETF.com's weekly video series. I'm Sumit Roy, Senior Analyst here at ETF.com. I'm joined today by Rachel Aguirre, U.S. Head of iShares product at BlackRock, the largest issuer of U.S.-listed ETFs. Rachel, great to have you on the show.
Thanks for having me. Excited to be here.
Absolutely. So Rachel, BlackRock is obviously the biggest ETF firm in the U.S., but one thing that always strikes me is how you never sit still. You're always out there launching new products and seeing what sticks. So that's where I want to start. You had quite a few launches in the second quarter across asset classes and across investment styles. So why don't we start with your most recent launches, the iShares Buffer ETFs? Can you tell us about the two new funds in this category that you launched?
Absolutely. And you're right. It has been quite a busy quarter for us. We're really excited about these launches. And if we start by just, let's look at what these products are designed to do. Our iShares Buffer ETFs are really meant for investors who are interested in equity growth, but at the same time, they're looking for some degree of downside protection should markets experience negative returns. So these products give investors exposure to large cap equities, in this case, specifically the S&P 500, while providing a buffer against market drawdowns. That comes in exchange for a return cap. So the iShares Large Cap Moderate Buffer ETF, that ticker is IVVM, that seeks to protect against the first 5% of quarterly losses. And then our iShares Large Cap Deep Buffer ETF, that ticker is IVVB, that seeks to protect against quarterly losses between 5 and 20%. And I'll tell you, there are three reasons really why we're excited about these particular products. The first is the market relevance. And, I know, listeners know this, volatility just continues to be a top concern for many investors out there. As a result, we're just seeing a massive amount of cash sitting on the sidelines. It continues to sit there. We've seen over 940 billion flooded into cash products in the last year alone. So the question is, well, what's going on here? And investors are facing a dilemma. On the one hand, they want to invest, but at the same time, they don't want to experience those potential drawdowns that come with market volatility that, by the way, we expect to stick around. So what we love about these products is that they're really giving an entirely new set of tools for investors to confidently begin to reinvest so that they can position themselves to capture some of that equity growth while still managing for volatility. So that's the first reason. The second thing we really love about these products is the access that it's creating for investors. The reason for this is that historically option-based strategies were pretty difficult for your average investor to access. They were either, limited to expensive products or held in more complex structures. The advent of option-based ETFs has just entirely changed that. So this is giving investors institutional quality risk management solutions, but in the convenience of an ETF wrapper. So we love that. And then there's one more reason, and that really comes down to the design of the product itself. We believe that our ETFs are distinctly different from competitors because they are specifically designed with the buy and hold investor in mind. So there's two key features here. First, these products reset quarterly rather than annually. Resetting the options on a quarterly basis allows the strategy to more frequently update to prevailing market conditions. And in volatile markets, what we know is that the buffer and cap levels can become stale relatively quickly. So this feature removes the need for an investor to trade in and out of a product. And then secondly, importantly, they're priced at 50 basis points. And at 50, these are the lowest cost buffer ETFs in the market today.
You did mention, Rachel, that these were designed for the buy and hold investor, because I was going to ask you about that. Where do these ETFs fit in terms of an investor's portfolio? So I'm assuming they're not necessarily just short-term tools for people who are worried about the current market environment. They could have a more permanent place in someone's portfolio?
It's actually really interesting when we look at how existing buffer ETFs are used by clients today. You're right. We certainly see some clients who choose to use them tactically to express a short-term view on the market, but we actually see many more who are looking to use these products more at the core of a portfolio as part of, longer-term portfolio construction. There's a few different ways that we see these products being used. One is for investors who want to reduce risk within a portfolio. So what those investors can do is actually replace a portion of their core equity exposure We also see these being used as a great tool for individuals who are nearing retirement or within retirement, who actually want to add to their equity allocation, but they want to keep risk in line. So this is a really great tool for them as well. And then also, and this has become really clear this year, we've seen investors who are using these products as a way to step out of cash and back into the equity market. So the downside protection of these products are helping investors regain that confidence to re-enter the market. And again, it goes back to that's why we've built the products with that long-term investing mindset. We see a lot of the use cases being geared towards a buy and hold.
Now, I want to kind of shift gears, Rachel, and ask you about a pair of new active ETFs that you launched. Of course, everyone listening is well aware that the US ETF industry became massive thanks to passive index-based funds. But active ETFs have been picking up steam, and you recently launched the BlackRock Flexible Income ETF and the BlackRock Large Cap Value ETF. Can you tell us about these products?
Yeah, and you're absolutely right. Active ETFs are one of the fastest growing areas of the overall ETF industry. It's a very exciting area. And this is yet another set of launches for us that are really significant. I like to think of these products as you can think of them as an epic combination, right? They're bringing together the best of two worlds, active management and ETFs. And so they're giving access to our industry leading active investors. At the same time, they're providing all of the features of ETFs that we love, right? Liquidity, transparency, tax efficiency. The BlackRock Flexible Income ETF, ticker is BINC, that is managed under the leadership of Rick Reeder. He's our CIO of Global Fixed Income. And that product pursues enhanced yield opportunities, and it uses a diversified approach, a nimble approach. And what it's giving investors exposure to is some of those harder to reach fixed income sectors. So think things like high yield, emerging market debt, securitized. And what's really unique, what we personally love about Think is that that product's been specifically designed to sit alongside core bond exposures within a portfolio. So what that allows is, for investors or advisors to be able to customize within their portfolio how much yield enhancement they want. So it's incredibly complementary to core bond holdings within a portfolio. And then the other product you mentioned, the BlackRock Large Cap Value ETF, that ticker is BLCV, that's managed under the leadership of Tony DeSpirito. He is our global CIO of fundamental equities. This product expands our premier value platform. What it's delivering is a value-focused exposure that, again, is designed to be used at the core of an investor's portfolio.
So I'd be curious to know, Rachel, your views about the prospects for active ETFs long term. Do you expect that this is going to be a large segment within the overall ETF industry, just as active is a large segment of the overall mutual fund industry? And secondarily, how do you see active ETFs fitting into investors' portfolios?
Yeah, we do believe that there is a lot of growth potential in front of us for active ETFs. We think they're incredibly complementary to mutual fund lineups. We believe there's absolutely a place for both and will continue to be. But active ETFs, in many ways, is bringing together a lot of, that you get the benefits of the ETF wrapper. We know for certain types of investors, things like tax efficiency really matters, right? And so when we look at how these ETFs are being used by clients, we see particularly strong demand coming from fee-based advisors. So it's extending the reach of certain types of active strategies now in an ETF wrapper. They're also particularly well suited to be used as building blocks for model portfolio builders. So we see that as another area. So models that are looking to differentiate their offering. And then at the same time, because like all ETFs, these products don't have any minimum investment required other than the price of the ETF itself. So we actually see active ETFs as giving end investors new ways to access active management strategies. When we look at how we see these products fitting into our overall product lineup, they're really an important new avenue of choice for our clients. So our clients don't have to decide between ETF and active management. They can choose the strategy that's right for them and in their preferred fund type.
So, Rachel, we've talked about some of your new launches, but outside of those, what other products are you seeing investors being interested in right now?
Yeah, well, I'll go back to the topic of volatility, and how that continues to be front and center on people's minds. Investors know how important it is to remain invested because, like the saying goes, time in the market is much more important than trying to time the market. We know that holding too much cash leaves them at risk, of missing out on bond or stock market performance. And so, what we see and what investors are coming to us looking for are ways to stay invested while managing the risk of volatility. And so, what we're seeing right now is a lot of money and investors turning towards higher quality exposures. And that's the case both within fixed income and within equities. For fixed income in particular, we are starting to see investors beginning to move into those longer maturity exposures. We appear to be coming towards the late stage of the tightening cycle here. So some, flows are going. In fact, we've seen more than 27 billion in inflows into intermediate and long-term fixed income ETFs across the industry year to date. When we look at, an ETF like our core US aggregate bond ETF, that now yields close to 4.7%. So that's beginning to look quite attractive. On the equity side, investors are preferring higher quality companies, those companies that have strong balance sheets, low leverage, resilient earnings. And so, in that sense, we're seeing a lot of interest in our quality factor ETF. The ticker there is QUAL. It's a great way for investors to get exposure to those high quality equities.
Well, fantastic. So much great information, Rachel. Thanks so much for your time.
Thanks for having me.